Today I'm going to discuss the unthinkable, that emerging markets could begin to outperform developed markets. If we look back over the last 20 years, emerging markets have underperformed developed markets and the world index, and most of that underperformance actually happened in the last decade. They hit their zenith in November 2007, just before the GFC. What's driven the performance of emerging markets? Really two cycles in the last 20 years. From 2000 to 2008, the dollar was weak, emerging markets did particularly well. So too did their levels of profitability. Emerging market input costs are generally in dollars, and when the dollar weakens, they leverage their large factory base for output, which also obviously leads to high levels of profitability. From 2008 onwards, of course, we had the GFC, and emerging markets struggled in that period of disinflation. They underperformed developed markets quite heavily. That was both a function of profitability and a very strong dollar for that next 10-year period, which we've still got today, in fact. Why should this change? Really, the same two reasons. Firstly, dollar weakness. We think we might be coming to the end of the super dollar strength period. The economy has hit its top levels. We're seeing inflation peaking out, and probably the end of the interest rate cycle too. So the supercharged dollar might be close to the end of this cycle. Then secondly, and probably very importantly, sell side, or the market's upgrading emerging market earnings, and we're actually seeing upgrades that lead to superior earnings growth for emerging markets versus developed markets for the next 3 years. So we could be at the beginning of a typical cycle which we saw develop in 2000. This is out of the box thinking, but it's worth a look, and emerging markets are trading at a 26% discount on a simple multiple basis versus developed markets.